Okay, it gives me great pleasure now to bring on board Neelesh Surana, CIO of Mirae Asset Management. Neelesh is someone whom you rarely see on television. He's somebody who has the ability to really look at the big picture. He's followed a very simple but a disciplined approach of investing, and some of his funds have really given very handsome returns on a 10-year period, which means that there is a very strong process driven methodology which Neelesh and his team at Mirae Asset Management are performing. So what is Neelesh's view and Mirae Asset Management's view on the market? Where are opportunities in this market? What is happening to flows? And a take on valuations and much more. So Neelesh, fantastic to have you on the show. Thank you for joining us. Hope everything is fine and safe with you personally and with your employees and friends.
Thanks, Nikunj. Thanks for the generous introduction, and it's my pleasure to come on this show.
Neelesh, in last 6-7 months, we've seen both the extremes in the market. A gut-wrenching fall, excruciating pain, a fall which we've never seen in the history of capital markets, followed by a rally which has been completely unprecedented, unplanned, and has caught everyone with surprise. So what is the real market? The one we saw in March, which was painful and unreally cheap, or the market which we are staring right now, which is elevated and a bit stretched? Where do you think markets will finally settle?
No, yeah, so you're right. The pace of recovery, I mean, both the fall has been recovery has been very violent. I think markets are indicating that perhaps the war is not won till the time we find a medical solution to COVID-19. But still the worst is over. So what was not right was the March drawdown, because that time there was a lot of anxiety and unknown aspects of pandemic when it initially started. And but as things are sort of settling, people are getting grip to the data points, and there is also view that the welfare cost of lockdown is greater than the benefit. And more importantly, recent spike in infection is accompanied by low fatality rates. So the and another thing from an investment angle, what happened is this entire episode of COVID, if you look at it, damages the cash flow for 1 or 2 years. Whereas if you do a DCF valuation of a business, the value doesn't fall by more than 5-10%. But the damage to the price during the violent fall during the March was quite significant, 40-50%. So probably that realization that the price drop for an event which will impair the cash flows for, let's say, a year and a half is much more than the inherent value of the business, and price and value have to be bridged. I think that also came in, along with the fact that what happened over the last 6 months is we can't see the pandemic in isolation. We'll have to see what's happening globally and in India in terms of the response to the pandemic. And particularly worldwide, we have seen a massive unleashing of liquidity both by government and central banks. I mean, real yields are permanently suppressed. And to that extent, I think all in all, I would say the market today is, let's say, about 6-7% YTD down. That's a reasonable zone. March clearly was unwarranted. And to that extent, it has sort of nicely come back, taking a more longer term picture of the damage to the cash flows, and then again retrace the closer to reasonable valuations.
Neelesh, markets ultimately are a function of EPS into PE. Now EPS has not gone up, PE has gone higher. As of now, there is no big breakthrough even on the vaccine front. Everybody is buying stocks with the assumption that tomorrow will be better than today. Don't you think somewhere markets have stretched themselves? Because all of us have gone in our earnings recovery assumptions. We've gone wrong in our assumptions or earnings recovery assumptions for last 4 or 5 years in a row now. So while there is a lot of liquidity, I just want to bring out the point on where markets right now to you are looking stretched largely because of hope and hype.
No, so Nikunj, when we talk about EPS and PE multiple, I think I would like to highlight few points. First of all, entering the pandemic, pre-COVID, we were going through a bad phase, and it was not that corporate India was doing extremely well. They were coming out of a recession, so the PAT to GDP was 2.5%. That is after the tax cut. So it's not that we were doing extremely well. There was a recovery which was about to happen. So the base was in that sense sort of favorable for earnings to improve. Second is, let's not dissect too much of earnings for the current year. It is all erratic. If you look at PE multiples, FY22 is talking about 18, 19 times for the Nifty. And this we think is reasonable for two reasons. One is earnings, even in FY22, would be suboptimal to the longer term potential. If the longer term potential is like 4.5% of GDP as a profit to GDP, we would be still significantly lower than that. And second is this entire P multiple should also be seen through the lens of lower interest rates that reduces the equity risk premium. So I don't think that P multiples at 18 times FY22, which is also slightly subnormal earnings, are expensive in a low interest rate regime. And lastly, the better way to look at value businesses in such sort of dislocation, where 1 year cash flows and earnings are very erratic, is to look at price to book, because price to book do not give a better indicator. So Nifty price to book, which is around 2.4, 2.5 times next year, is closer to 5-year mean. So it's not that markets are exorbitantly expensive. I would say it is reasonable. Some pockets are cheap. Okay, some pocket would be probably closer to the pre-COVID level and maybe slightly on the higher side.
Right. Neelesh, the gray area in the market right now is financials, given that we don't know how the post-moratorium picture is going to move, what will happen to NPAs. Banks are certainly not lending. But in your declared portfolio, what is available with us, you have a very large exposure to financials, about 25-26% weightage, which is almost in line with what the benchmark is. So what gives you a conviction to run a position or have exposure to financials, which is very large in nature?
Yeah, so you are absolutely right that financials have been laggard in an otherwise strong market. They are still down 20-25% YTD. And we clearly see value in these in this bucket because the long term, some of them are winners, particularly the stronger franchise, and near term disruption is only impairing the cash flows. I mean, basically the anxiety on the loan loss provision only for a year or so. That's one. I think multiple factors why we are positive. First is obviously these are very strong franchise, and these will get much more consolidated like in many businesses. And pandemic also came along with certain events like what happened to Yes Bank or a PMC sort of bank. So to that extent, there is a bit of consolidation on the liability side. So there'll be few strong franchise which would come on the other side of the virus, and that's one. Second is the moot point is not on the credit growth, because that would recover over time. It is a function of the GDP growth, but it's more to do with the asset quality. I think, again, we entered the crisis when the corporate book was looking as already seen the worst. So there is not much of problem on that side. It is perhaps to do with retail and the business loan, which we have to observe how the delinquency will pan out. So it's too early to say because the restructuring guidelines have come in. Moratorium is over. It does appear that the restructuring guideline is much more pragmatic. And our view is that overall stress, overall loss given default would not be significant. I mean, ballpark for well-managed franchise, it will be, let's say, at max 1 year of pre-provisioning operating profit. So to that extent, and many of these companies, many of these banks have very strong balance sheet. They have high capital base. They have low cost liability franchise and sufficient capital raise and provisioning buffer. So all in all, we see that it's a classic case where near term is impaired, and by near term I mean, let's say 1 year, and the longer term is intact, and valuation is in our favor. So that's the reason, Nikunj, we remain sort of positive and overweight on retail corporate oriented banks.
Neelesh, now there are two sectors which have really made a strong comeback. It could be a coincidence that they both are global in nature, which is IT and pharma. But if I look at the underlying narrative is that domestic businesses, which is banks, they are struggling. But global facing businesses like IT and pharma, they've made a comeback. So are markets telling you that focus on global recovery, which is going to be better than the domestic recovery?
No, Nikunj, both have different dynamics, and to that extent, it is not that they are correlated in terms of why they are holding on and moving up. I think If I have to, let's say, quickly look at IT, clearly what has happened is because of the pandemic on the demand generation side, we have seen steady improvement in deal closures across segment because enterprises across sectors are embracing digital. This entire digital piece has been a game changer, and that would mean an acceleration of IT investments. And also commendable work on the demand fulfillment side in the IT sector. In the technology sector is actually benefiting from higher offshoring given the adoption of remote working. This work from home concept is actually, I mean, it would not have been done otherwise. So that along with savings, let's say from travel and rent, these are helping the margin side. So overall, there has been tailwind in the IT sector, both on account of demand coupled with margin resilience. So that has been on the IT side. On the pharma side, of course, different reasons have been there. And again, it's been another COVID-proof sort of sector. I think one thing is, the base was favorable. I mean, people, if you remember 1 year back, pharma stocks were not doing well. Our own pharma fund is up 50% in last 1 year because the base was low. It was going through a bad patch. On that, there were 2-3 things. I mean, one is inherently healthcare business has structural growth drivers, both on the domestic and export markets. I mean, on the domestic market, it is much more secular and it is driven by increasing health spend in India. And particularly the positive rub-through of the pandemic on the pharma sector has been, it has provided an opportunity for India to be counted among preferred alternate hub for pharma products. I mean, be it API, key supply materials, formulation, etc. So that has only strengthened the India advantage, India chemistry advantage on that. In addition to that, there has been a recovery in the US generics. So multiple factors has led to outperformance in pharma. I mean, both the factors are different. I think both are very strong, longer term secular growth businesses. And we are positive on that. That said, of course, because pharma has moved too fast too soon, one has to, let's say, particularly on the sectoral fund, one has to be much more, put money more through a SIP route rather than a committing lump sum.
Right. You know, that's a fair point in terms of where the market is positioning IT and pharma companies. But if one looks at the two extreme ends of the market right now, Neelesh, one side you got PSU banks, you got metals, you got PSU stocks, and a stock like ITC. They are available at throwaway price, much below their intrinsic value. On the other side, you've got India Mart, Jubilant Foodworks, D-Mart, stocks which are trading at P multiples of 100 plus. Why do you think we have two extremes in the market?
No, so your observation is right. I think we are grappling with this sort of divergence, but it has been blurred. I mean, if you look at it last 1 year, as I said, healthcare is re-rated. One other sector which was not doing well was the small and mid cap. So that has got significantly re-rated. If you see the divergence, if you look at BSE 500 companies YTD, almost 225 companies have given positive returns, of which 128 companies have given more than 20% return. So it's not that it's so polarized, but yeah, you are right. Certain sectors are at a deep in value. They were deep in value even pre-COVID, government entities, some of the names which you mentioned. I think we see it as an opportunity, but the important thing is the business should have longevity. And secondly, when looking at value stock, it should not be pure value without a basic growth and a trigger to that. So I think triggers are very important in unlocking value. For example, you mentioned about some government entities, let's say oil marketing companies. Now we have in next 6 months or a year, a very big trigger, which hopefully should happen, which is a strategic sale of one of the entities. If that is a event, then definitely it will re-rate. It will have an impact on re-rating in general many public sectors, and in particular, obviously, that specific sort of stock. So I think this value debate is there. I think within value, one has to filter that businesses should have basic growth, double-digit growth, and there should be some trigger for the businesses to sort of turn around in terms of the cash flows. We see this polarized sort of market more as an opportunity than debating why it is so polarized.
The base effect for IT would kick in. Okay. Now, stock market is the only place, Neelesh, where some would argue that gold is available at the price of silver in a bad market. Similarly, gold trades at a price of diamond in a very overbought kind of an market. So where do you think right now there is silver available and diamond available?
Yeah, so I mean the value zone within the markets. I mean, as you can I think classify into three buckets where the market is. I mean, there is a bucket which is less immune, less impacted by COVID-19, FMCG, IT services, pharma. I mean, and also telecom. Within this, I think it is more fairly priced. They are in the whole zone. It's gold for gold types, and except for telecom we see, because of various reasons, there is a mispricing in the sector, particularly one of the companies. So the second bucket is businesses which are impaired. Again, some are impaired where the demand is destroyed for few years, but some cases it is only deferred for few years. So here we see maximum value, where, as I mentioned earlier, where near term, let's say 1-2 year is impaired, there is uncertainty, but it will mean reward. And valuations are reasonable, and this is where we see the maximum value, and the bigger names. So the biggest name in this come clearly is banking in one sector, which is in this bucket, where because of uncertainty and credit cost, there is low valuation, but the 3-5 year view is intact. So here we see a value on that. The third piece where we see a value, which again I touched earlier, is a pocket where there were stocks which were deep in value even pre-COVID, government entities, utilities, energy, some of the one of the consumer companies, and now telecom. And there were stocks which have been in deep in value even pre-COVID, and they have become further sort of interesting. So I think across markets we are seeing quite a bit of companies in the whole zone, and equally good opportunities in the buy zone. And that said, just to sort of complete the liking, I mean, we would prefer businesses where there is longevity of growth. I mean, businesses where we like it from a very longer term growth perspective, whether it is in the consumer discretionary space, financials, insurance, healthcare. And as and when you get ideas within that space at a reasonable valuation, I think the market is providing some opportunities even at current valuations.
Now, Neelesh, you're managing $6 billion, and some would argue that $6 billion of equity with this kind of a size would be a challenge. So what should investors expect in terms of returns now? Because frankly, finding good companies in India is always a challenge.
No, so if I have to correct, I mean, this amount is spread across 9 products, and each has a different mandate. There are the largest product is about $2.5 billion large cap fund, which is managed by my colleague. And so there the challenge of liquidity size is much less, because we are probably half of what the largest fund in the country is. So, and otherwise also top 100 companies are very sort of liquid. So I think we can't see at an aggregate level size being a challenge. Of course, other thing remaining same, if it were a small cap fund or if it was a more mid cap oriented fund, and if the size is large, then it can become a challenge. In our case, because it is spread across 9 products, and it has inclusion, all the products have flexibility to invest in larger companies, next to 50 companies. So to that extent, I don't think size is a bigger challenge. If it were to be challenge in any of the products, we would sort of take proactive action in terms of sort of soft closing the product, which we have done in one of the products about 3 years back.
So where do you think the economy is headed in terms of large cap concentration? Because each sector has few leaders. If there are few leaders in each sector, then what will happen to mid and small cap stocks? One view is that large and mid cap stocks will have dominant market share gain, and the shape of the economy is going to change. How will investing change in this kind of an environment? Because if smaller companies will struggle, they will not survive, they will have problems, they will have capital allocation challenges. So what is the future for mid and small cap stocks?
Sure. So one thing is, it is not that it is skewed. I mean, this rally YTD, if you look at it, is not skewed towards few stocks. Almost 60% of the market is about 200-day DMA. And as I said, almost half of the BSE 500 stocks have be in positive returns. So it's not a skewed few stock rally. A lot of companies in the mid-sized businesses, agrochemicals, chemicals, pharma companies, they have generated good returns. That said, I think your observation is absolutely right. So it is not to do with size. I think it is also to do with some qualitative aspect of how the business is positioned. See, when you have such large dislocation, earlier there were events like demonetization, GST, and now pandemic, which is such a large dislocation, once in a century event, what comes out is the inherent softer aspects of the company. It's not only the quantitative strength of the balance sheet, it is the softer aspect of the management which comes to the forefront. The thought leadership of the management, the ability to steer the challenges, and probably in fact use this as an opportunity to grow organically, etc. So the point I am saying is there will be consolidation across businesses, but that will be more to do with the qualitative aspects of the company's management rather than only size. And that consolidation is happening because will also happen because some of the weaker names, regional names, will not be able to sort of survive. So that consolidation would happen, but it will also happen in mid-sized businesses. Many of the businesses are mid-sized businesses, agrochemicals, chemicals, footwear, many of the names in the manufacturing side. So there also consolidation will happen. So long answer, but the common thread would be, and your observation is right, that there will be consolidation, but that will be more to do with the inherent strength of the business. And that's the reason it is very important for investors to avoid the weaker ones and stay put in these stronger names, which will come winner on the other side of the virus.
Mr. Surana, great conversation this morning. Thanks so much for joining us for that special discussion today.